Hello and welcome back to the Note. Today we have seen a further rebound from the very sharp falls you saw across the world after the Brexit referendum. Does that really mean that we've made up all the ground, that the panic is completely over? In some ways yes, in some ways no. I'm now going to bombard you with charts to show you what exactly has been retraced over the last few days. First and most importantly, let's take a look at sterling, obviously the most directly affected. This is Deutsche Bank's trade-weighted index for sterling against a basket of countries, heavily weighted towards the euro, which, because it's also been very negatively affected by the Brexit referendum, means that it doesn't look as dramatic as if you were to look at the same chart of sterling against the dollar or the yen, but the picture remains the same. This has been a very sharp fall that has been only very slightly retraced, and we are near the bottom of recent ranges. Now, one sense, however, in which things very much have cleared up is the sense of concern about a true Lehman moment, true tension for the financial system. First of all, let's take a look at rate expectations coming from the Fed funds rate futures market. You can see this is the odds put by investors on the chance that the Fed funds rate would actually be cut by the end of this year. A quite remarkable occurrence if that were to happen. Presumably could only be justified if the contagion from Brexit were to turn into some kind of a Lehman-style, very serious crisis for the world financial system. You can see that that was a very sharp rise in rate cut expectations, which has now been almost completely cancelled out. Similarly, if we take a look at this next chart on the VIX, this is how much people are prepared to pay again to protect against volatility in the equity market, a spike and then a recovery. Now let's move on to the stock market, and if we take a look at what's happened in this next chart to both the FTSE 250, which is the main index of UK smaller companies, and the FTSE 100, which is the main index of the largest international UK companies, and the Euro First 300, which is a broader European index, you can see the rebound very much in place there, actually slightly up for the year. However, this is denominated in sterling, which is a much damaged currency. Now let's take a look at this same chart in dollar terms, and you can see there still a radical fall for the year, particularly for the FTSE 250, and plainly much more negative outcomes for the main indices for the UK and Europe. A lot of the impression that there has been a really big rebound here is driven by money illusion, currency illusion, the fact that the currency is weakened so much. If you want another indicator that perhaps tension remains high, let's take a look at a couple of the biggest banking stocks in Europe. Barclays and Deutsche, again these are in dollars. You can see very serious falls in both cases. Again, a sign that there is still some degree of concern over the financial system. Finally, let's take a look at the UK stock market in long-term international perspective. This is how the FTSE 100 has done relative to FTSE's index of all of the world, excluding the UK. Goes back to the early 90s, back when the Maastricht Treaty was being negotiated. And you can see it's a quite remarkable steady decline. Being a member of the European Union has not stopped the UK stock market from losing a lot of value compared to the rest of the world. But as you can see from that sharp drop at the bottom, leaving the European Union has done nothing to help that. That, I think, is where we are at present. Plainly, concerns of a true Lehman event that were there very briefly for a couple of days have abated, but equally, it's still important to note that the standing of the UK, the perception of value and risk in the UK remains very different from what it was a week ago.